towards the rupee as well as the bond markets. Today is the government's FY15 borrowing calendar which kicks off, and the 10-year yields, remember, have hardened past that 9% mark last evening itself, and it's holding at that 9% mark. So what does it hold, and how successful will the first auction of around 16,000 crores be? Manish Wadhwan, MD and Head of Interest Rates at HSBC, joins in to talk about all of his expectations. Hi Manish, thanks very much for joining in. So that is my first question to you. Has all the supply pressure been factored into the markets, and are the markets factoring in some sort of a threat of a devolvement this time round? Because we do understand, or reports were indicating, that the underwriting was quite high in at least for, that's what we saw yesterday.
First of all, I think the underwriting has been on expected lines,
okay.
So it was not too high. It is definitely higher by a few paisa, but I think in terms of basis points, it's quite nominal.
Okay.
I think to answer your query regarding the government borrowing program, when it's starting today, there are some new paradigms which have come into the market, and markets are grappling with those kind of factors. Especially the first point would be the change in the term repo structure which was available to the system earlier. You know, RBI has changed in its policy now. The reliance on the overnight markets, overnight rates, to less than 20,000 crores and repo, and the rest of the money is available through term repos. This is one of the factors which the market is still trying to grapple with. So the overnight funding at what the banks used to borrow, which used to be unlimited amounts, now a term premium is being factored in, which is definitely instrumental in repricing of the government bonds or any instrument what we talk about. So mild adjustment has been on that account also. Secondly, I think in the end of March, the liquidity has been a bit tight, and the overall accommodation from RBI on 29th March was something like 2,65,000 crores, which is coming down now sharply with government expenditure and normal release of money. So, you know, things are balancing out, and we would see the impact in the bond markets also. And to the specific bond auction today, I think we have adjusted quite a lot on the yield terms, and it should settle around the current market yield levels.
Manish, hi, morning. What about the currency market? Do you think the strength is done? We now have a floor at the 60 mark, or do you see that, or do you see the currency breaching 60 in near future again?
On currency, I think there are two specific factors which I would like to point out. Number one is the last quarter, which is January to March for in India, is always there are some seasonality issues in terms of a lot of FDI money which is contracted comes in at that point of time, and a lot of balance sheet considerations are also there at that moment which play into that fact, and there's a lot of dollar supply. Going forward, that seasonality definitely reduces, but on the overall structural view on rupee, I think the most important point to look at is the current account deficit last quarter. We are expecting it to be somewhere around zero, and I'm talking about Jan to March. And even in the next quarter, it seems that it shall be under control. So the fundamental factors are quite, I would say, strong for rupee at the moment, though you would see some kind of gyrations what are happening today. One more important factor for rupee in the short term would be the decision by RBI not to allow, or SEBI not to allow, rolling over of the treasury bills investments by the FIIs. That would tantamount to some kind of a demand when they pull out this money or when it matures. So these are some small technical factors which are playing at the moment, but I think overall bias on rupee is positive and shall remain positive. I would refrain from commenting on a specific value of rupee. That really doesn't help.
Okay. Manish, I just actually wanted to take that point forward with regards to the FIIs and the short-term securities. How much of an impact do you think that has had on the bond markets, and how much of incremental flows will possibly not come into the markets simply because of this? How much of the markets were seeing hot money coming in from FIIs into short-term T-bills?
No, first of all, I would say it's not hot money at all.
Okay.
This is, let's bifurcate between two separate set of investors. There are people who are looking at the short end of the curve, which were investing in treasury bills, and there are guys who are long-term investors and who look at 5-year, 10-year and 15-year paper. The demand for the long bonds has not got affected at all because of this. RBI has taken a call that because people are investing in very short-end term money, which is 2 to 3 months, and they have said that when it gets rolled over, you should be looking to buy something beyond 1 year. But to be specific, the impact could be they hold around 5 billion worth of treasury bills, out of which we expect that nearly $3 billion worth is only for 2 to 3 months. So that means that should expire by June.
Okay.
So I think that is the only impact what we are looking. It is not a very material impact at all.
Do you think that the FIIs will invest as much in the debt markets as we've seen in the quarter gone by? In the Jan to March quarter itself, it was over close to around 30 to 35,000 crores that we've seen FIIs pump in to the debt market. Do you think that momentum will possibly continue?
The issue would be this $5 billion is more or less that 30,000 crores what we are talking about, the treasury bills which got invested. This will roll back, and then we'll have to wait and watch and see how much does it translate into the corporate bond or the CPs which they are allowed to buy even at the short end. I think at least 50% of the money should get rollover in the next quarter also, but not to the same extent what we were seeing in T-bills, because the kind of liquidity what we see in treasury bills, and you can do bigger lots, are not possible to do it in the commercial paper market or the corporate bond market for the shorter tenor. So I think out of this $5 billion, 2.5 approximately should come back in form of the other debt in the next 1 or 2 months. And besides that, the long end, there is an interest, but I think there is always that lull period which starts in April, May, and definitely some investors are looking out or waiting out for the election results to take a final call on those things. But on a fundamental level, I think few things which are very important. The current account deficit is in a far better shape what it was, and all the capital flows would add to only reserves at this moment. I think on the reserve front also we are in a far superior situation. The market positioning is also far superior. So all things put together, there doesn't seem to be any reason that you would see a major outflow, number one, or there could be any big gyrations in bond markets or through the debt FI route. I think I'm looking for a very stable quarter on the FI front in debt markets.
Okay. Last question then on the yields then. What is the level that you're expecting the yields to possibly harden to or maybe soften to? So what would your range in the near term be? And have the yields factored in that there could be possibly no rate cut based, or maybe there could be a likelihood of a status quo or maybe even a bias towards tightening in the rest of the year? Is that something which the yields have already factored in?
I would have to admit this is the toughest question you're asking me at the end. It's really difficult to predict, but I would say a lot of adjustment has already happened in the markets, and hearing what Governor Rajan spoke after the monetary policy meeting in the press conference also, there seems to be a very low probability even at the moment for a rate hike or rate cut in the near future. So I think we are in for this 8% repo rate for a long haul. It seems so, at least 3 to 6 months. Okay. In that kind of a scenario, the technicals come into play, and that is demand supply of the system, and how does the liquidity pan out, and what kind of demand do we see from the FIs, etc. But net, I would say I think a lot of adjustment has happened already. I don't see yields actually going more than 10-15 basis points from here, even if a big adjustment has to happen. So in the sense, I think after this so-called 20-25 basis point adjustment which happened in the last 5 days or 10 days, we are looking at a stable quarter here from April to June.
Okay. Fair enough, Manish. We leave it at that. Thank you very much for joining in. So that's the view coming in on the yields as well as for the rupee, at least in the medium term. Maybe that 8% mark on the yield should hold, which is around 3 to 6 months according to HSBC.